Hello! Welcome to this guide from the experts at Pro Tax Accountant. If you're a director of a limited company in the UK, the next few minutes could literally save you thousands of pounds. We're diving straight into how to pay yourself for the 2025/26 tax year in the smartest, most tax-efficient way possible.
So let me just ask you this straight up. Are you 100% sure you're keeping as much of your hard-earned profit as you legally can? Because if there's even a tiny bit of doubt, you need to stick around. Getting this wrong is an expensive mistake, and frankly, it's one you just don't need to be making.
So here's our game plan. We'll kick off with the basics of how you get paid. Then we'll get into that big debate, salary versus dividends. After that, I'll show you the optimal pay strategy for this year. We'll also touch on what to do if you have multiple directors, explore some pretty cool advanced tax-saving tactics, and, crucially, look at the common traps you need to avoid.
Okay, first things first. Before we can get clever with tax, we need to be crystal clear on the main ways you can actually take money out of your company. It all starts here, and you'll see it's actually pretty straightforward.
You've got three main levers you can pull. First up is your salary. Think of this as your wage for being the director, for doing the actual work. It goes through the official payroll system, just like for any other employee. Second, you've got dividends. This isn't pay for work. It's your reward for being an owner, a shareholder. It's a slice of the profits. And third, there's the director's loan. This is basically borrowing from your business. It can be useful, but the rules are super strict.
All right, now we get to the heart of it. This is the big one. How you balance your salary and your dividends, well, that's the absolute core of your tax strategy. Nailing this mix is what will make the biggest difference to how much cash ends up in your personal bank account.
So let's put them head to head. A salary gets hit by two things, income tax and national insurance. But, and this is so important, your salary is a business expense. That means it reduces your company's profit, which lowers its corporation tax bill. Dividends, on the other hand, are different. They're paid after the company has paid its tax, but you personally pay a much lower rate of tax on them. Also, a salary helps you build up your state pension entitlement. Dividends don't. See, they both have a powerful job to do.
Now let's talk numbers. This number right here, £12,570, is your new best friend for the 2025/26 tax year. This is your personal allowance. It's the amount of money you can earn without paying a single penny of income tax. This is the bedrock of our entire strategy.
And here's our second magic number. Once you've used up that tax-free allowance, dividends are taxed at just 8.75%. Now compare that to a salary, which would be taxed at 20% income tax plus national insurance on top. You can instantly see the huge tax saving you get by switching to dividends at the right point.
So let's put these pieces together. This is what you've been waiting for. We're going to build the perfect tax-efficient pay structure for a sole director this year, what we call the sweet spot. This is the strategy that hits the perfect balance.
And honestly, it's beautifully simple. 4 steps. Step 1, you pay yourself a salary of exactly $12,570. Why? Because this uses up your tax-free personal allowance perfectly. No income tax, plus it's enough to count as a qualifying year for your state pension. Step 2 is done. Step 3, take everything else you need as dividends. And step 4, the pro move, try to keep your total income, salary plus dividends, under that £50,270 threshold to avoid higher rate tax.
Let's make this real. Meet Alex, a freelance developer based in London. He follows the plan. He takes a salary of £12,570. His personal tax on that? 0. Then he takes the rest in dividends. Now you also get a small tax-free dividend allowance. That's the first £500 tax-free. The rest, $37,200, is taxed at that low 8.75% rate. So look at that. On a total income of over 50 grand, Alex's total personal tax bill is just £3,255. That's incredibly efficient.
And here's a quick pro tip, just to really hammer this home. Remember that salary? It's not just about your tax. It's also a tax-deductible expense for your company. Every pound of that salary reduces the company's profit, which means a smaller corporation tax bill at the end of the year. It's a total win-win.
Okay, so you might be thinking, that's great for one person, but I run my business with my partner. Well, you're in luck, because when you have more than one director, this strategy doesn't just work, it actually gets even better.
The key is something called the employment allowance. Now, if you've got 2 or more people on the payroll, like 2 directors, your company can claim this. And for most small businesses, it's enough to completely wipe out the company's national insurance bill on those salaries. It makes the whole strategy even more powerful.
So check this out. Both you and the other director can each take that £12,570 salary. The company gets double the tax deduction, and the employment allowance can cover the NI cost. Then, you just split the leftover profits as dividends. If you bring your spouse in as a shareholder, you can use their tax-free allowances too, which can slash your total household tax bill. It's a fantastic way to structure things.
So we have absolutely nailed the salary and dividend mix. But don't think we're done yet. There are other really smart ways to get value out of your company. Stay with me. This next point is a genuine game changer for building long-term wealth.
So let's look at the rest of our tax-saving toolkit. We're talking about company pension contributions, claiming every single legitimate expense, using a little-known perk called trivial benefits, and if you're careful, director's loans. Each one is a powerful tool in its own right. Let's start with the heavyweight champion of tax planning, pensions. Your limited company can pay up to £60,000 a year straight into your pension. That payment is a full-blown business expense, so it cuts your corporation tax bill. And the best bit? You personally pay zero income tax and zero national insurance on it. It's an unbeatable way to invest in your future and get a big tax break today.
Okay, now for a fun one. This is a brilliant little tax hack called trivial benefits. The rule lets your company give you small gifts, completely tax-free. Now, the rules are specific. It has to be under £50, it can't be cash, and it can't be a reward for doing your job. But you can get up to £300 worth a year. Think a birthday gift, a team lunch. It's a simple, legal way to take a little bit of value out of the company tax-free.
Right. We've talked a lot about how to do things right. Now we need to talk about how things can go wrong. Knowing what not to do is just as critical, because these are the mistakes that can get you into hot water with HMRC.
So, please, avoid these red flags. Taking only dividends and no salary. HMRC sees that as a problem. Paying yourself a dividend when the company hasn't actually made a profit, that's not just a mistake, it's illegal. Taking out a big director's loan and not paying it back on time, that triggers a massive tax charge. Putting your spouse on the payroll when they don't do any work, a huge no-no. And finally, forgetting the paperwork. You absolutely must have board minutes and dividend vouchers to prove everything is above board.
And, at the end of the day, it all comes down to this. This isn't about some sneaky short-term tax dodge. This is about building a business that's strong, that's compliant, and that's going to be profitable and sustainable for you for years and years to come. Look, we've covered the best general strategy today. And for many people, it's perfect. But your business is unique. Your goals are unique. The right answer for you might be slightly different. And that's why getting advice that's tailored specifically to you is always the best move.
If you're ready to get a plan that's built just for you, I can't recommend the team at Pro Tax Accountant enough. You can reach them on WhatsApp or give them a call on 079856899912. Or just drop an email to info@protaxaccountant.co.uk. And for more fantastic tips just like this, make sure you hit subscribe on their YouTube channel. Thanks so much for watching.